Okay, so let's move on to the next trade now. This is a real live trade in the market with broker execution. Watch carefully to see how I put on, manage and exit the real live trade. Here's trade 3. Okay, so looking at Swiss franc right now. This is US dollar against Swiss franc. And what I can see here is we've got a downtrend, a nice downtrending chart here. We've got MAs all coming down. We've got all the MAs in the right position. And what I see here is an A to B. We've got a potential B to C, and then a C to D going down. So this is going to be a strategy 1 trade if it pans out. So what we've got here is, first of all, let's see, is the B2C retracement currently above the 50% mark to make it a valid play? And we can see, yes, it is above the 50% mark. So if this carries on going down now, we can take this for a trade. So let's see, at what price do we have to go in? Well, first of all, we've got the high here as 1.1397. We've got the B point here as 1.1349. We've got the C potentially at, and I'm saying potential because we can still get a higher high right now, but right now it's at 1.1375. And so the distance between A and B, A being at 1.1397 and B being at 1.1349, is 48 pips. So our entry therefore has to be 25% of that from point C. So 25% of that is 12 pips, and 12 pips lower than 1.1375, which is the C point, is 1.1363. Our stop, well, where will our stop go? Our stop will go above the C point. So let's see quickly how much we need to trade before this entry actually happens. So if we go to our trade size calculator, we've got a $50,000 account, let's say. Let's say we want to put in 2% risk. It's US dollar against Swiss franc, CHF. Entry price. Now, the entry price is going to be, if we quickly go back and see, now at 1.1368, we have the bid and ask at 69 and 72. So 70 and 72 when we're at 70. So what we want to do is we want to put, it's 1 pip, let's say 1 pip lower on the sell side and 2 pips higher on the buy side. So let's say our entry price for going short here is at 1.1362. And our stop price is 1.13. Let's say we want to put our stop at 1.1378. So 2 pips higher than that, it will be 1.1380. So we then calculate, and we want to put in 631,222 currency units. So I'm going to do 630,000 currency units. So if we go here, we're going to right click here, do create entry order. We want to sell USD CHF 630,000 currency units at 1.1362. And if you just do advanced, and we want to put a stop at 1.1380. And we just click OK. And our order is there, it's waiting for US dollar against Swiss franc, 630,000 currency units, selling at 1.1362, and our stop at 1.1380. And so price is going down, so let's see if we're in. Yep, the order has disappeared from the orders window and it's gone down, it's gone into the market, and it's in our open positions now. And as you can see, it was 630,000 and we're in at 1.1362 and our stop is at 1.1380. So now let's see where we need to move our stop to break even. Where is our break even point? Well, we know the distance between A and point B is 48 pips. Our entry was at the 25% mark from point C. And now what we need to do is determine a 1-to-1 risk-reward ratio. So let's do that by looking at what our stop was. We wanted to put our stop at, let me just mark it up. We wanted to put our stop at 1.1378. Just a little bit higher than that. There. We wanted to put our entry was at 1.1363. And now, if we see, that is a difference of 15 pips. So 15 pips lower than 6.3 here, this price of 6.3 is where we want to move our stop to break even. So at 48, which is just there, 15 pips higher is 63. And so at this price here, when price reaches here, we are going to move our stop to break even. And after that point there, we will put our limit order at the D point to take our profit, and our stop order will be there as an OCO order at the break even point, which will be our entry point. So let's wait and see what happens with this trade. Okay, so we just got price fluctuating in between our entry and our break even price. So we're just waiting for the price to come slightly lower for us to move our stop to break even. So just waiting on that. And so I'll pause the video and I'll restart in a few minutes when we see maybe a bar or two show up so we can see where price is going. So price has just been kind of going sideways and it's starting to move down towards our break-even price. And as you can see, price hasn't gone down in a straight line as the A to B went. And that's okay. It's alright. Price may hover around a little while. You don't care about any of that. All you want is for your prices to be hit and for you to do what you need to do at those prices. So we're going to wait now for that break-even price to be hit. As you can see, it's coming close to it. And then once that break-even price is hit, we are going to move our stop to break even. Okay, so we're going through that price now. We have hit our break even price. So what we're going to do is we're going to go here and we are going to move our stop to our break even price. So we're going to change this stop. And it's very easy to see that here. We can see where our stop originally is. And also where we entered, and that's the price that we want to move our stop to. So we're going to move our stop to 1.1362 and we're going to click OK. So as you can see, our stop has moved to the 1.1362, so we entered at 1.1362, and if we get stopped out now, it's going to be at 1.1362, which means that we come out at break even, zero loss. Now, also, we can do an OCO order and we can give the broker our target price. How do we work that out? Well, we saw from A to B, our prices were 1.1397 here and 1.1349 here, which makes it 48 pips between the A and B point. And from point C, which is 1.1375, 48 pips lower than point C is 1.1327, and therefore at 1.1327 we want to take our full position off at 1.1327. So when it gets to this point here, we want to take our full position off the trade. So we will go here and we will put in a limit order. You click on limit and we're in a short, so we are going to buy back, and a limit order automatically means that you're going to be doing the opposite to what you're in the trade for. And at 1.13, well, 27 is the market price. 2 pips above that is where we will buy back. So at 1.1329 we will buy back at a profit. And there you see, our stop is at 1.1362 and our limit is at 1.1329. And now it's an OCO, an order cancels order. Whichever one gets triggered first will cancel the other order. And so either our profit target's hit and it will cancel our stop that's in place, or our stop is going to be hit and it's going to cancel our limit that is in place, our target level. And so we just sit back and just wait to see what the market does. So coming close to our target price. So we want it to come to 1.1329, and we can see it's at 30 and 33. Remember, we're looking at the buy price here, the 33 price, not the sell price, because we sold first, because we're in a short. Remember, we're in a short. And now we want to buy back to get out of our position. And the buyback is this price here, the 33. We need this 33 to turn into a 29, so go lower, in order for us to come out at our target level. So let's wait and see what happens with our trade here. I'll just pause the video and restart it in a few minutes time. So we're getting closer to that price now. Let's see what we've got here on. There you go, it just got hit there. As you can see, we've gone lower than the 29 price, and our close position here, the USD CHF one, is in $1,835 profit. So we do get a bit of slippage on the actual trade itself between the market price and the broker price. Obviously, the smaller ABCDs and the smaller moving charts mean that there will be more slippage with the broker spread. So if you have a high moving, fast moving chart that moves many pips and it's a larger ABCD, then those little 1 or 2 pips that you add to the entry and the stop prices means that there's less slippage. It means a lot less to your overall risk reward. So you got to also look at that and look at whether you want to trade those charts where maybe the increments here on the right here are too small. Like here it's 1.1349 to 1.1354, so there's only 5 pips in each of these grids. Maybe you want to only trade the charts on the 5-minute where there are at least 10 pips in between each grid, which means that your slippage, your broker slippage, means less and will affect your risk reward less. And there you have it. That was another profitable strategy 1 trade. So that was broker trade number 3. Now if you click over to the next page, I'll take you through another trade with broker execution. This is Kumar and I'll see you in the next video.